welcome to another episode of Break Away from the Rat Race. And today I have the pleasure of speaking with Veena Jetti, is the founding partner of Vive Funds, a unique commercial real estate firm. Veena brings a dynamic perspective to targeting, acquiring, managing, and operating assets using best practices combined with cutting-edge technologies. Veena, welcome to the show.
Hi, Eric. Thank you for having me. I'm excited to be here.
Great. Well, Veena, tell us how you came to real estate and commercial real estate and start Vive Funds.
Yeah, so I am the daughter of a successful real estate investor. I'm the daughter of two immigrants. My parents came here back in the 80s and from India, and they decided that, my dad came here for education. He came here to do his PhD, and he's an engineer, did, the W-2 route. And by virtue of his job, he was traveling 45 weeks out of the year when we were kids. My sister and I were kids. And my mom wanted to contribute to the household, and she wanted to do something that didn't require her to be away from us for so long. And so she started a real estate company and started investing. And she was, effectively taking care of us alone. And so my sister and I would have to go to closings and walkthroughs and tours. And we grew up in this world. So I went to undergrad, got my degree in finance. And I graduated when I was 20 years old. So I was young. I thought I knew a whole lot more than I actually did back then. And my mom asked me to come work for the family business. And I said no, because I knew what I was doing. I had a degree. I was an adult. I was going to do something completely outside of what she did. And so I worked in corporate real estate and, learned a lot, made a lot of money at some of the best shops at the world, left ultimately my corporate gig back in 2012 and started investing for myself.
Wow, this is great. This is fantastic too. I mean, we haven't talked about that, but women as a role model in real estate, it's great. There are a lot of women that are real estate brokers, real estate agents that are very, very successful, obviously. But in real estate investment, there are few and far between. So it is so great that you even had your mother as a role model to take care of the kids, and then on top of that, start a real estate investment company. This is fascinating.
Thank you. Yeah, no, I totally agree. I mean, there are not many women in investment, and especially what I do now in the multifamily commercial side, we're in private equity really, and there's not a whole lot of women, and definitely not women of color at this kind of transactional level. So I'm excited about it. And that's actually one of the reasons why I do what I do, is because I have twin daughters that are 2.5. And, I don't want them to feel like they can't do this if they want to, or they have to choose between, a career or a family. I want them to know that they can do both. And I think that representation is important.
Oh yeah, absolutely. So I think this is great. This is fascinating. And there's a lot of network. I was Women in Real Estate network and all of that help each other. You have different different perspective, different ways of doing things, and also how you're. I don't want to speak for you, but it's a little bit more difficult to be, I would say, understood by your partners when you're a woman in real estate. So this is great.
Yeah, and I'll say, so the last several deals, about the last 250 million that we've acquired, it's actually been a joint venture between two women-led companies. One was your former guest, Ellie Perlman, and myself. And we actually, I'm very excited about it because it doesn't happen very often, but we have been transacting in our capital markets as also a woman-led team as well, which highly unusual is in that space too. So it's been really exciting and really fun to work with so many women. I'd never had that opportunity before.
No, that's fantastic. So tell us more about so you got started, you decided to, obviously you gained a lot of experience in commercial real estate, and now you said, okay, well, this is now I'm ready to go and do my own thing. So what was is it because you found a deal first, or you just said you had enough of the filling out forms and
Well, I mean, ironically, I do more of that now than I did before.
yeah, yeah.
But
Oh,
I think that so the reason I left was because I paid taxes married to my husband, who's a high income earner for the first time, and we were both W-2s. And
mhm.
I called my mom and was like, "Mom, we were living in DC at the time." I was like, "Oh, what just happened?" And she was like, "Yeah, you need to consider, becoming a full-time real estate professional, getting the designation." And so she, she was there to really guide me through that process. I wish it was more interesting. Like, I had a great deal, and it was just that it was time for me to go out, and I had a supportive spouse, and that really helped. And we shared the same vision and same goals of what we wanted to do.
Yeah. No, so this is great. So for the audience out there, so there already when you're working full time, you have a full-time job, you invest in real estate, you have tax advantages. But
Mhm.
when you dedicate yourself to real estate investing, you don't need necessarily to be a real estate agent, a real estate broker. You can spend significant amount of time in your real estate business, and you can be considered a real estate professional.
Yes.
And that way, all these tax benefits are just amplified. You can
Yes.
basically take out a lot more of these tax advantages and offset other active income. So
Absolutely.
that's so as if it was not good enough when you're working. When you dedicate yourself to it, it gets even better.
It
So
does.
this is great. So tell us about your first deal. So you get out of this corporate gig and you say, okay, well, I have to do something different. And how did you get started? Because yeah, you kind of have a whole support team when you work in the corporate world,
Yes.
and now you're on your own. Now you have all the hats are in front of you. You're the accountant, you're the the
I'm the
finance person.
janitor. I'm the
Exactly.
admin. Yep, I'm everybody.
Yeah.
Yeah. So my first deal, I actually started by buying condos. My mom's portfolio was a residential portfolio that she had built. So I didn't really think about going to commercial real estate at that time. So I started in single family or condos, and then moved to single families. I was so busy at one point. I was buying like 5 houses a week. But it's
Wow.
very tough to get to true scale, right?
Yeah,
So
yeah, yeah.
it's impressive when you're first starting out and you're maybe buying one or two in a year or every few months, but you cannot get to the scale you can get to in multifamily by buying single family homes unless you're, a $1 billion hedge fund of some sort. So
Mhm.
that was when it was kind of an inevitable switch into the multifamily space. And I really like it because for our personal portfolio, we are just conservative investors by nature. And so it's a very stable asset class with a good Sharpe ratio or risk to reward ratio.
Yeah. So yeah, and I mean, 5 houses a week is it's a lot of houses.
Yeah.
For us to do this, I mean, we are doing like well, we sold 120 houses last year. We're on target to do 180 this year with a very small team, and we can only do this by having addition like an expanded team on the ground with realtors and contractors and all that kind of stuff, and also using technology.
Yes.
And I don't want to touch on technology just yet because I know you're using a significant amount of technology in your business. But
Yeah.
yeah, that's kind of so these houses that you bought, your strategy was they were cash flowing from day one. Were they kind of like a burst strategy? What was the plan with those houses?
Yeah, so the initial plan was going to be to go in, fix them up, and flip them out. But because of the volume I was doing and the relationship I had with the local bank, they were like, "Hey, have you considered, just keeping them? Let us take on a portfolio loan, and we'll utilize that to give you essentially like a guidance line of credit, which is
Yeah,
like a credit card that you can go and buy
yeah,
houses on for all intents and purposes. It functions the same way." And so I actually started keeping them. But the biggest challenge you have with either small multifamily or single family, and this, is management is not easy, property
yeah,
management. And I do not like the property management side of business. It's like easily the part that's my least favorite about what we do.
Yeah. So you're doing your own property management you were doing that on the single family, and you're continuing to do that on the commercial side?
No, so now on the commercial side, we're fee managed. So we have
Okay.
sales. So most of our assets we're buying, the last three have been $80 million each. So they're significant scale and size that we can bring in, and we do underwrite for third-party property management. I think that in any kind of multifamily, what ends up happening is if you get to a certain amount of scale in a geographic location, then you kind of get into a point where you almost are going to end up bringing it in-house.
Yeah.
We don't have any plans to do that yet. We have really great property management partners, and we're very hands-on asset managers. So we haven't really had a need to do it just yet, but maybe in the future, who knows?
Okay. So yeah, so this is very challenging when you're also doing for the single family. I'm going to stay on this for now,
Yeah.
but ramping up 5 houses a week, and then the refi on the back end. So you're basically doing kind of like a burst strategy,
Yeah.
refi on the back end, and then doing the property management after that. Wow, my hats to you. Were you by yourself doing that, or?
I was. I
Wow.
was by myself. I didn't even have like the whole team that I have now.
Yeah.
It was very busy and very challenging. But because the other thing that people don't realize when you're doing these like fix and flip or anything that involves a significant amount of rehab is if you have a good crew, you have to keep them busy. Otherwise, someone else will take them that's busier than you. And that's it. You have to start all over again. So I needed to continue buying so I could keep my crews busy so that they weren't going and looking for other jobs. So that was a different challenge. And, being a woman in that space was also an interesting dichotomy because construction crews weren't really that used to having a woman directing them and telling them what to do. There were many times I had to have like my dad come and be like, hey, what's happening here? Because I just could not interact with them in a way that needed to happen.
Yeah.
So that was definitely challenging. And I was young. I didn't know as much as I know now. And I think it'd be different if I tried to do it now, but it'd be probably harder because I know the luxury of scale.
Yes, exactly. So this is very good, very interesting, because this is kind of the route I was going when I got started. I mean, this is kind of the route we were going. Had no intention of doing a turnkey rental property, being turnkey rental providers. We were just building our own portfolio, and then we were doing portfolio loans on the back end. And then that dried up. Then they kind of like, we couldn't find another portfolio lender. After that, it was, and then things didn't work out. And then we had people that were interested in turnkey side of things.
Yeah.
So then it's okay, well, let's just do that instead.
Yeah.
So, all right. So so after that, you ramped up your single family up to a certain point. How many houses did you have in your portfolio when you decided to I need to scale it differently?
I actually don't know. I don't know that I've ever counted it. It was so long ago.
Yeah.
Maybe a few dozen at one point. Because we had single families, we had condos, we had individual lots, and I started selling them off too. So as we were acquiring, we'd start selling too. So we were always kind of like in a buy and sell because the market was really hot then.
Yeah.
It wasn't as hot as it is today, but it was very hot at that time. And what we thought was kind of the top of the market too. So we started selling off assets. We were buying 5 a week was like at our busiest point. We certainly did not have enough deal flow to get 5 a week consistently. I wish we did, but it was usually it would be like 1 or 2, maybe every week, every other week, but some weeks were great weeks.
Okay, great. And then at one point you come to the realization that you have to come up with a new strategy. And this is, so I want to emphasize that because it's important for the audience to realize that you may start with one strategy at the beginning, it's going well, and then you may decide to continue with that strategy and tweak it, like what we have done. We started building single family, and then we decided to, okay, let's just go and turn that into a turnkey provider business. And then you made a different decision, also good decision, to do it to do it differently. So what is the turning point, and kind of like how the decision making happened with that?
Yeah, I think the decision making, I didn't really realize how big of an undertaking it was to switch until I was in it. But I think that for me, the catalyst was really in the logistical issues with trying to scale single family homes, single family portfolios, the desegregated location of each asset. And I live in DFW, so I was doing the vast majority of my portfolio was here in Dallas. I had remote assets in DC and Pittsburgh as well, but nowhere near the amount that we had in Dallas. And even here, to get to some of our assets would take an hour, and it's just not practical to be a one-person show. And so it was either bringing on more people, and for me that was really tough because I like to control and I like to know like the quality, and it also became a huge hassle to lifestyle because I was the one answering calls at 2 a.m. and I tried using third-party management, and I just couldn't get anybody that would handle issues the way I would have wanted to. It's not the same. The incentives aren't aligned there. And so that was a really big challenge. And that's when really I said, okay, to get to the type of scale that I know we can get to and I want to get to, we really need to move into larger assets. And one of the interesting things was actually on the capital side. So initially I'd started out just investing our own capital for ourselves. And I had no plans of taking in investor capital. I had no plans of getting into the private equity space. It was actually kind of like by accident that we did, because I'd have really good friends of ours ask us like, hey, Veena, can you like teach me how to do this on the weekend? And I get it, because everyone thinks it's like passive income mailbox money.
Yeah, exactly.
You and I both know it's not exactly passive income or mailbox money, right?
We make it look so easy. And then,
it's all smoke and mirrors. And that's the thing. I was like, no busy orthopedic surgeon that works 100 hours a week. I can't teach you how to do this on the weekends, because I work 100-hour weeks doing just this and nothing else. And so then it kind of became, okay, well, whatever you do next, I'll just give you my money and you just invest it alongside you. Like if you're putting 50,000 in, I'll put 50,000 in. And I was like, okay, I mean, I understand this concept. I haven't thought about doing this. And the conversation kept coming up over and over with multiple friends. And so I reached out to the securities attorney that I've been working with for over a decade and kind of asked him what that would look like. And that's when we really started getting more into the private equity space, and we had the ability to start scaling.
Yeah, we did a lot of, we had a similar situation. It's very funny. People that, oh, I want to lend you money, I want to participate and stuff like that. So we did a lot of joint ventures and private money, private money lending and stuff like that. And this is just like more work on top of everything else. So
more work and more responsibility, actually.
Exactly. So you finish a project, and all of a sudden now you have a partner that you have to do the project accounting and tell them, oh yeah, this is how much we did. And then they ask question about, well, this, how much, why did you spend over budget on improvement and all that. You know the thing. So okay, so that's good. So then you had a bunch of people that wanted to do. They had capital. They were ready to invest with you. They knew that you were successful. But it sounds like, from what I'm gathering here, like you didn't kind of like, you just had these people, but then you didn't think that a single family was really the right space to kind of like leverage that capital for the next paths.
To your point, reporting and keeping all of the accounting in like a very meticulous way that's appropriate for investor facing would have been a massive challenge for us at that time. And the actual irony of it is, everybody says they want to invest capital, and then when you are like, hey, write a check, when you're just starting off, all of a sudden there's a lot of capital that's nowhere to be found, right?
Exactly.
The first deal that I raised capital on, I think we needed a total of about 1.2 million. And I was like, okay, there's enough people that have already, said that they were going to do this. So many people were like, oh, it's not the right time, or I just did this other project, or I have this expense coming up. So I actually thought our first project, I was scared that we weren't going to be able to close and perform on it. Thankfully we were, but that was like the most stressful 6 weeks. And then, once you take in investor dollars, the responsibility is completely different. I have
Mhm.
not slept the same since taking in an investor dollar. It's just the nature. But, today we've perfected our systems and our strategies. So now on like our last few raises have been around $30 million, which we do in 42 days with no issues.
So tell me about that first deal where you had to raise like the 1.2 million dollars. So what was like the purchase price and what was the plan with that?
Yeah, so we were JV partners with somebody
Mhm.
who had, the track record and the experience, which definitely added a lot of comfort for us as we were getting into the space. We had theoretical knowledge, we had our practical knowledge, but real world experience cannot be replaced. And so our part of our role in that was raising the 1.2. We had, other roles in the asset. We bought about 200 units here in Dallas, and which was nice because I could, actually go put eyes on it, walk the asset, be hands-on with it. We bought it for just under 16 million, and we actually exited it 3 years later. And I think we exited that one at like 24% IRR. So
Yeah.
it was a very good deal for investors, did very well.
Yeah.
It was a very successful project, and it really put us in a position to continue scaling and growing. Today, we won't even underwrite deals at 16 million. It's just too small for us at this
Mhm.
point. But that's how you start. You start with, like you said, one business plan, you see an opportunity, and you make these small pivots and adjustments until you
Yeah.
end up where you really want to be.
Yeah, exactly. Yeah, absolutely. So in terms of so these deals, so you mentioned, we talked a few times about kind of like technologies
Mhm.
and stuff like that. So tell us a little bit more. We don't talk too much about technology,
Yeah.
but it is important consideration because that makes it super efficient. Make sure that you don't drop the ball on anything. So tell us some of the technologies that you're using in your business to make sure that things are efficient and high quality, etc.
Yeah. So we operate as much as possible from like an automation standpoint. We try to automate certain things. But every decision we make at Vive it starts and ends with how does it affect investor returns and how does it affect investor experience. Both of those things, I'm very sensitive to those because I want our investors to have the white glove experience, right? And so um, we will expend extra dollars or we will do manual work if the investor experience is not where we would want it from an automated. We will not automate if it doesn't enhance that. So in that, we started to find small ways that we've been able to kind of increase our touch points with investors. So on the capital side, we automate all of the communication. We automate our document signing process, everything so our PPM and our SEC filings and everything, we automate all of that. We automate communication to investors. We pride ourselves on communication. So we put out like our monthly updates and our quarterly financials to our investors. We increase our communication in times of uncertainty, like when COVID hit. We immediately increased communication. We started adding, conference calls or videos so that investors knew that we were still on top of it. We didn't know what was going to happen, but we were
Yeah.
watching it closely and we were ready to react as needed.
Mhm.
So that's with the capital side. With the acquisition side, we utilize AI technology for our assumptions. So we have data points that are really, really specific, and they come from millions or hundreds of millions of data points, which gives us really good ability to predict kind of where the asset can or will move on our pro forma. So it gives us an opportunity to get really in the weeds and fine tune our numbers. And that's cool because as as computers and AI learn more or is exposed to more, then we get better and better data. So it's exponentially increasing over time with this type of semantic technology. And then, we also obviously automate like the administrative side. That's pretty easy to do. And I'd say that's probably like the first thing most of us try to automate.
Yeah.
And then
All the
operational.
chores.
Yeah, exactly. All the things that are like no one should be bothered by this. We have like our Calendly and our Zooms and all of that stuff. And then also, because we have a JV partnership and we're two completely separate companies, a lot of times we have to integrate, and we're both fully functional companies. We can take any deal cradle to grave independently. So it's dividing and conquering, but also making sure that that redundancy is shared. So if there were ever a time where I need to step in and handle a role my JV partner would be, or vice versa, we have access to all of that data and information, and we can see that and touch and feel and interact with it.
Okay. So when you're talking about your JV, are you talking that you're sharing GP role, like general partner role in a deal, and then you syndicate the deal? Okay.
Yeah, so we co-sponsor the deal together, and so we're the only two co-sponsors on our deals, and we raise all of our capital in-house. We don't actually raise institutional capital at the moment. And so everything we do is retail capital. We target, acquire, raise the capital, stack the debt, we operate, execute, and the goal is to exit successfully at the end of it.
Yeah, and your role, so Vive Funds includes both you and the your JV partner or the GP, or this is just your side of it?
Just mine. So Vive is my sister and I are actually partners at Vive.
Okay.
So we're the only two. The buck stops with us. Good things, bad things, all of it comes back to us.
Okay. And then so you're partnering with, and then your expertise is under the acquisition, the capital raising, and what else?
Yeah, so I touch all aspects of the business in some way or another. So really what we do in our JV partnership is we kind of get together, we divide out the roles, and it works really well because the roles that Ellie likes to do are things that I'm like, I don't want any part of that, and vice versa.
Yeah.
We could, but that's the beauty of having a partner, a strong partner. And so I really, I spearhead the legal side, the security side, the capital raise, the due diligence. I handle that personally. She really is handling the targeting, negotiations. There's like a million different parts to a deal, so I'll spare you the whole list. But generally my favorite part of our deals is the capital structure and legal structure side.
Yeah. No, so that's good. I was kind of like wondering if you had like a construction partner that was kind of handling all and then you were kind of overseeing everything else, or how that was working.
We do have construction teams that we bring in-house via third-party management, but we don't have a construction arm within Vive. It's Vive and Blue Lake. We've been JVing together, but we're separate companies, so to speak.
Okay. Yeah, no, that's good. Very good. Thank you for that. So now what are some of the deals? What's your target deal? What does that look like?
Yeah, so today we target anywhere from like 70 million is really the lowest price that we want to be looking at. Now, does that mean we won't underwrite like a $50 million deal that's next door to one of our assets? No, of course we would, but generally we're targeting 70 to 120, 130, 150 million. We're not getting any of these deals because the competition is insane, but that's what we're targeting.
That's right.
So we're looking at like Class B value add assets. In 2021, it's very tough in this space. And 2021, we did 2 deals, and 2020, we did all 1 deal. So it's very tough. But we are patient investors, and we co-invest with our LPs. So it's very, very important to us that we do great projects instead of a lot of okay projects. And so that's why we just don't do, if we don't see a deal that makes sense or we can't put our name on it or reputation on it, we just don't do it.
Yeah. So that's, so how many any minimum number of doors, or?
Yeah, usually when you're at that size and kind of in the vintage that we're looking at and the markets we're looking at, we're roughly somewhere around 300 and up. We'll underwrite anything 200 doors and up, but we have a strong preference to 300, 400, 500 doors. Bigger the better, really.
Yeah. So. Yeah, that's a space that's a little crowded. It's too crowded for me, that's for sure.
I feel the space, the like 30 million and less is more crowded.
Mainly even lower than that.
Well, but once you get to like that 10 to 30 million, that's like a different class. And then you get like 30 to 50, and then you get like 70 and up.
Yeah.
And then you get to like 150 and up, like to $1 billion deals. So, but I feel like our space is not as crowded with sponsors that are raising retail capital like we are. We see a lot of institutional competition, and we see a lot of family offices compete at this size, you know, life insurance companies. So that's really who we're competing against, which is kind of nice because it gives, we're not winning on price, we're winning on terms. Pricing, these are all highly sophisticated investors. There's not, you know, if we're losing on price, we're losing by like $5 million. We're not losing by like 100,000. And so we're competing on terms. Our terms are very aggressive. And because it's just, you know, one decision maker from each company, we can move very, very quickly. We can shorten up some of our due diligence periods. We can, you know, utilize our risk capital a little bit more efficiently. And so that's how we've really been able to get the deals that we have today.
Yeah, oh, that's good. And this is so this is hard to find deals right now. I mean, even for some of the multifamilies that we have, the kind of our target, it's still very hard to find it. It's hard to find things that in class B, class C that need renovation. A lot of it is already done, and then you're kind of like at the 6% cap rate and or lower.
6% cap rate. I would buy those.
I'm in midtown. I'm in the middle of the country here. So
no. In our markets, like we get excited when we see like a +4 cap rate.
In Dallas, for sure.
In our market, we're in Dallas, so we're in Texas, Georgia, Florida, North Carolina, South Carolina, Arizona. If the deals we're going into, there's no way we're getting into a 6 cap. I'll buy everything.
So that's good. So the other thing too that you do very well is kind of like basically being able to raise from high income earners, right? So and I think everybody, if you're new to investment, or even if you've been investing for a while and you're planning to grow, you should, if you haven't done so, you need to kind of build your network of investors so that you can raise some money. Eventually you're going to need money. I mean, my favorite saying is that it doesn't matter how much money you have, you're always short a couple of millions. And every time I think, oh, I have lots of money.
No, that's definitely true.
You always need money. So building that network, and I think you kind of have specialized in the high income earner. So what are kind of like some of the dialogues? How do you access these kinds of high income earner? How do you talk to them differently than other people, etc.? So what are some of your kind of like your secrets for?
And the secrets, so the biggest secret I could tell anybody about raising capital, and if you want to get to the scale of capital that we raise, is knowing your numbers inside and out. No one will ever know my deal better than I do when I walk into a room. So every question investors ask me, I can answer it. Like 95% of them I can answer without even having to refer back. So I study our markets, I study our materials. I know everything inside and out. That's one. But more importantly, raise that capital when you don't have a deal. It's a much different conversation. So for example, at this very moment, I have no deal. If you came to me and you said, hey, Veena, I have $1 million and I want to invest, I'd be like, awesome. I don't have anything for you to invest into, but here's how our process works. Here's our strategy. Here's our team. Here's our track record. I'll give you all of the things you need to vet every single thing about who we are and decide if we're the right fit, except for a specific deal. Once I have a specific deal, then all you're doing as an investor is you're looking at it and you're saying, yep, this deal works. This is what she said it was going to be. I get it. It makes sense. I'm in, or no, I don't like it. And I always ask investors for feedback if they say no. The no is far more useful to me than the yes is. Like, I know why you love our deals. We love them enough to put them under contract and to invest into them ourselves. Tell me why you don't love it, because that gives me an idea of who you are as an investor. Is it the wrong timing? Do you hate this market? Do you just never want to work with me because you don't think I'm a good sponsor? Like, whatever the reason is, it's fine, but I like to know that so that I know how to kind of not advise, but direct my investors as we get new deals. So if someone's like, hey, I'm just like way too invested in Atlanta, we might come out with a deal and I might ping them and say, hey, we just put out a deal in North Carolina. Make sure you take a look at it because I know you weren't interested in Atlanta and this is outside of that market. So that's also how I have those conversations. And I don't change my conversation whether I'm talking to somebody who has no money or somebody that's a billionaire. My conversation actually remains the same because my perspective is, and I was very much raised this way, that we treat, the janitor the same as the CEO, and the same goes for my investors. Because one, I don't know who they know. Two, I assume that everybody has the opportunity to be an accredited investor at some point in the future. So every conversation I have is a potential investor for me. And I never, ever discount anybody who is just starting out. We all started out as unaccredited investors. So that's always been our philosophy. And it goes very much hand in hand with our investor first philosophy. And that goes for all investors, not just accredited investors.
Yep. So, I mean, this is great advice. And I think I think this is true as well, is that, start raising money, like I was suggesting as well, is like, start talking to these people before you need the money, because, and you will need the money eventually if you're growing your business. So it's much better to have a conversation with someone when you're not selling them something, and you just say, hey, this is what we do. This is what we did.
Right.
And then, and then this is how our investors did.
Yeah.
And then then later on, maybe they're interested in something that you have to offer.
Exactly. It's too hard to try to get them to do all of the due diligence they need on you and the company and the philosophy. And it might be the first time they've ever heard about this type of passive income. And so you want to handle all of that when you're not also trying to do a million other things to get a deal closed. And at that point, you want it to be just about that specific deal. And if I could tell younger me something that I wish I would have done, it's that I wish I would have set up processes and systems when I didn't need them, because now at the scale we're at, it's a lot harder to retroactively implement all of these things. And we've had to, because there's no way we can raise $30 million in 42 days without having some level of efficiency built into. I cannot make an individual phone call for an hour or two to every investor individually at that point. I want to, I would love to do that because that's my favorite part of what I do. But that's why I say, like, invest into those systems, processes, set expectations early, and always deliver on what you say you're going to do. And if you can't, communicate why it's happening, so that there's that trust built. And the biggest KPI I look at when I am looking at my investors is how many are reinvesting with me. I want that long-term relationship. I don't want someone to invest once. And so about 80% of our investors are in 2 or more projects with me, which means a lot to me. And I try to keep that number as high as possible.
This is great. Very good. So Veena, if people want to reach out to you, how can they do that? How can they touch base with you?
So you can find me on my website, Vive Funds, VIVEFUNDS.com. And I have an investor portal, so you can log in there. You can see all of our offering materials if we have anything at the time, which we probably won't at this rate. But you can see kind of what we do and who our company is. You can also schedule a call if you're interested in talking about the investment process. And then if you want to just connect with me, I'm on social media, Veena Jetti, pretty much everywhere: TikTok, LinkedIn, Instagram, Facebook. I'm everywhere as Veena Jetti.
Great. Well, Veena, it was a pleasure speaking with you, and good luck. I hope you find a deal soon.
Thank you.
Take care.
Appreciate it. Take care.
Thank you for listening to Break Away from the Rat Race with your host, Eric Martel. If you want to share your story and experience with our listeners, please message us on Facebook at Break Away from the Rat Race. Also, please subscribe to our YouTube channel and our podcast on iTunes.